Welcome back. We are now in chapter 13, and in this chapter we'll be continuing with the coverage on case studies. So if you recall, in the previous chapter we have taken a case study on a fresh term loan. Okay, so we spoke of a company called PQR planning to set up a new project, right, an aluminum manufacturing unit, and this is a company with no past financials. Okay, because this is a new project. Okay, so when a company is setting up a new project and is applied for a term loan from the bank, what are the points we need to look at? We have seen in the previous chapter, right? We have discussed around some 40 points, right? And if you look into these 40 points for any term loan proposal, that should be more than sufficient. I think that will comprehensively cover all aspects of term loan appraisal, right? So having done that, we will now take another case study, and in this case study, we'll discuss the case of a company which is not applying for term loan. Okay, this company is not applying for any term loan. Okay, this company has just come for applying for a working capital limit. Probably it is already got an existing limit. Maybe it is coming for enhancement of working capital limit. But then this company had in the past, say last year or 1 or 2 years back, has taken a term loan from the bank. Okay, so whenever you get these sort of proposals, okay, it's very important not just to focus on what is the present application. The present application might be about working capital enhancement, but don't jump straight away into working capital enhancement. Start calculating the MPBF second method of lending, and don't focus immediately on the working capital assessment. Whenever you get a proposal which has a term loan component, already it's availing a term loan, you basically need to see whether it's a relatively new term loan or it's a very old term loan. When I mean old term loan, it means that it's like 2 years or 3-4 years back. I mean, by which time you already know that the project has been completed, right? The project has been completed, the operations have begun for this project. Okay, we are comfortable with the borrower bringing in his margin. We know what is the final cost of the project, whether there was cost overrun or not. We know that the borrower has met the cost overrun. We know everything about this project. That is what I mean by old. Old in the sense that it is gone. It has happened a long time back, and everything we checked for all possible gaps in the project, and all of them are covered. What I mean by relatively new term loan is this is a term loan that was sanctioned recently. A recent means not some 3 to 4 years back. No, this is a recent term loan, maybe 1 or 2 years back, and we don't know as a bank. We have not reviewed the term loan position. When I mean reviewed, we don't know whether the project has been completed. We don't know what is the final project cost, right? Because the bank has sanctioned term loan based on certain set of assumptions. Okay, so this is the project cost. This is your margin. This is your term loan. Based on set of parameters, is sanctioned the term loan. But we have not reviewed that. We don't know whether the project has been completed. We don't know what is the final project cost. Whether there is any cost escalation. Who financed this escalation, or the company was able to finish the project with a lesser cost than the envisaged cost, in which case it should not have availed the entire term loan, right? So there are various aspects to look into. So if you have not reviewed the term loan, right? If you have not reviewed the term loan in the last 1 year or 2 year of a recently completed project, right, it is very important that you do so, because that will let you know very important aspects. Most important, let you know whether there is any diversion of funds, because usually when there is a project at hand, it's very common that some short-term funds will be diverted for long-term uses. That's usually the case. Whenever there is a project, an ongoing project, an expansion project, or a new project, it is fairly normal to see that some short-term funds will be diverted for the project. So you need to also ensure that the working capital limit of this company was not diverted to the long-term users. So all of this will be possible only if you comprehensively review the term loan. Just because the company has come for working capital, don't focus only on working capital. If this company has availed term loan in the recent past, say in the last 1-2 years, and you have not reviewed the term loans in sanction, right, to now review the term loan also, right? So that is what we are going to do in this proposal. Okay, brief details about this company. This company XYZ is a private limited company and is engaged in manufacturing of ferroalloys. It's a manufacturing unit. It's promoted by persons who have prior experience in this line of activity. The 5 directors who have their own businesses. However, these days they are devoting most of the time in XYZ. So they have their independent businesses, right? So which we will consider as group companies. And they are devoting, however, most of the time these days in the present company XYZ. The field level investigations conducted by the bank reveal that the promoters are of experienced business. So the credit investigation, the findings of the credit investigation at the field level is satisfactory. There is no adverse market opinion on the borrower. So this unit is located in Achutapuram SEZ near Visakhapatnam. This is an SEZ. right? So most of the approvals would have been taken care of, like land acquisition and infrastructure and power connection, water supply. Maybe all of them obviously would be available because it's an SEZ. Raw materials for this ferroalloy plant are manganese ore, quartz and limestone, coke, and these are sourced from various mines in neighboring states of Orissa, Madhya Pradesh, and Chhattisgarh. These are neighboring states of Andhra Pradesh, so proximity to raw material is not an issue. The company set up a submerged electric arc furnace. This is one of the methods to which manufacture ferroalloys, right? Which produces 5,000 tons of manganese-based alloys. This is the installed capacity. And the finished product, as far as the marketing is concerned, the finished product is going to be sold to steel plants and rolling mills in Andhra Pradesh and neighboring states. The company was incorporated in April 2011. After completion of registration and other formalities, it is engaged the services of financial consultant. So DPR was prepared, the project report, and submitted to bank. The project cost was 9 crores, and the means of finance, right? The means of finance was 4 crores and 5 crores. 4 crores and 5 crores. 400 lakhs and 500 lakhs. 400 lakhs is the borrower's margin, and 500 lakhs is the term. So this is the project cost 9 crores, and this is the means of finance. Now, note that this is the envisaged project cost and means of finance. You have to note that this company, this is what envisaged in the project report at the time of sanction of the term loan, right? We are speaking of a case. Where the term loan was already sanctioned and 1 or 2 years have already passed. So we are now talking about is what was envisaged earlier at the time of sanction. What was the background? Okay, so this was the envisaged, the expected project cost 9 crores, and this is the means of finance. So the project cost majorly consists of 4 crores of plant and machinery and civil works of 2 crores. Land and building put together around 2.5 crores. So that's the major portion, and we have some other expenses. This margin for working capital also, right? So when preparing the project report, when submitting the financial projections to the bank for sanction of term loan 1 or 2 years back, this company has assumed this, made these following assumptions. So the projected financial statement submitted to the bank at that time 1 or 2 years back were based on these following assumptions. So we have various assumptions starting from the capacity. The capacity utilization seems to be okay. Sale price was assumed to be 60,000 per ton. So raw material requirement, cost of basic raw material, cost of space, various. Power 4 seems to be at a lower level. Labor, right? Labor, various expenses, okay? And these are the holding levels. And it was assumed that the DCCO, the date of commencement of commercial operation, would be April 2012. This is all envisaged. This was at the time of sanction of term loan. We don't know whether it is actually materialized. We will see that what has actually happened, but this was the plan of the company a couple of years back at the time of sanction of the term loan. So DCCO was envisaged, was expected to happen on April 2012, and loan repayment was in 5 years, 60 monthly installments commencing from April 12. This seems to be a repayment with no holiday. As soon as the DCCO, as soon as the operations have commenced, the repayment has also commenced. This is not usually the case, but maybe this was what stipulated for this company. Okay, so this was the assumption. So this is the projected P&L account, right? The company was expected to generate revenue of around 20 to 25 crores, around 21-22 crores, okay, for the next 5 years. That was the assumption. Profitability low in the first year because the first year of operations, right? But profitability is around 1 crore for the next years, okay. Why profit was so low for the first year? If you see, all the expenses were at the same level, but the general expenses is 2 crores, that is the major difference, right? Okay, so maybe there was maybe the project expenses, at least a part of the project expenses seems to be not have been capitalized. Okay, so maybe it was incurred in the first year itself. It's an option to the company. Some can capitalize. Some it's an option to either capitalize and transfer it to the gross block. Thereby you can depreciate it accordingly, or you can show it in the first year itself. And this company has chosen to show it in the first year. That's why the profit seems to be lower in the first year. Okay, this was the plan at least. Okay, this was the envisaged P&L account, and we can also have the projected balance sheet. This was the balance sheet projected last year. So if you remember, the 9 crores project cost was planned to be sanctioned, was planned to be met by 4 crores of promoters contribution, 5 crores of term loan. So 4 crores of promoter contribution, you can see here. This was the envisaged capital, right? Term loan is 5 crores, but because the repayment has started from April 2012 itself, if you remember, the DCCO was April 12 and repayment has also commenced from April 12. So 60 monthly installments, that means 5 years. So 5 crores repayment in 5 years. So every year 1 crore will be reducing. So by April 2013, 5 crores minus 1 crore, 4 crores. So that is what we are seeing here. Every year it will decrease by 1 crore. So this is also the projection. Okay. OCC was 2 crores and rest of all you can see. Okay. So we have seen what was the projected, what was the estimated project cost, what was the estimated means of finance, and the estimated P&L account and balance sheet as per the project report submitted to the bank a couple of years back. Okay. So the company then at that time approached the bank for a sanction of term loan of 5 crores, which was favorably considered and sanctioned in September 2011, and disbursement commenced in October 2011. Immediately you can see there was a discrepancy. The project report was prepared with an assumption that the loan disbursement will happen in June 2011. But whereas when it's come to actuals, it has actually the disbursement commenced in October 2011. So there is a gap of 3 months, right? Working capital limit of 2 crores was also sanctioned and was released in October 2012 when the commercial operations commenced. So October 2011 the term loan disbursement started, right? And DCCO, the commercial operations began in 2012. So DCCO happened in 2012 October. The envisaged DCCO, if you recall, the company has expected the DCCO will start in April 2012, whereas it was October 2012 when the actual DCCO happened. So again there's a delay of around close to 6 months. Okay. So now that is the background of the company, and now it is July 2013, the current period. Presently we are in July 2013, and the company has now approached the bank for enhancement of the working capital limit. Already this company was having a working capital limit of 2 crores. It is now asking for applying for enhancement to 4 crores. Okay. So it has now submitted the CMA data. Right, we are not furnishing the entire CMA format because there are a lot of blank rows. Okay, only the relevant lines are furnished here. There is also an assumption here that the sanction happened somewhere in September 2011, right? So we are now saying it's July 2013. So normally what happens is somewhere in 2012, maybe 1 year after the sanction, definitely there must have been an annual review of term loan, because all banks usually do this, at least for large projects. We are assuming that this has not happened because it is normal, because you see these sort of things happening. Even though the loan policy guidelines stipulate that term loans are to be reviewed, sometimes credit officers don't do that. Because the focus usually is on renewal of working capital limit so that it doesn't become NPA. Term loan becoming NPA is usually linked to the repayment. As far as the repayment is prompt, the term loan won't be classified as NPA. So as a credit officer, usually you'll be focusing on term loan, whether they're overdues or not, and whether the working capital due date is renewed or not, right? So in what happens in the process is you might miss out on review of term loans. Okay, so this company, because the working capital was released somewhere in October 2012, only in September 2013 when the OCC limit becomes due, only then you will be focusing on this company. Otherwise you'll be focusing only on the term loan overdue. So this is what happened in this case. Okay, so even though 2 years have passed from the sanction of the term loan, September 2011, and now we are almost in now in July 2013, almost 2 years have passed, but still there is no review of term loan that has happened. Had the review of term loan happened, a lot of things would have come out, which we are going to see. Okay, that didn't happen. Okay, so now this company has come for enhancement of working capital limit and submitted the following CMA date. So this is the projected profitability statement. Earlier we have seen a projected P&L account and projected balance sheet, but please remember they were the estimated P&L and balance sheet what we have seen earlier. That is at the time of sanction of the term loan in 2011. Those were the projections given, right, based on which the bank has sanctioned term loan. These are now what the company is giving now for the enhancement of the CC limit from 2 crores to 4 crores, right? So this 2013 is the actual figure, because now 2013 has passed. Now it is July 2013, right? So the 2013 actual figures are out. This is actual, whereas earlier what we have is 2013 estimates. Okay, let's go back to the table. So this P&L account projected, where the company has thought it will achieve a turnover of around 21-22 crores for the next 5 years. These are all estimates, including 2013. All these are estimate, and this is the estimated projected balance sheet given at the time of sanction of term loan. So it was thought that the promoters will bring in 4 crores and term loan will be disbursed, and repayment also would have commenced, and 1 crore would have been repaid by 13, and so on and so forth. This is the estimated P&L and profit and loss P&L account and balance sheet at the time of sanction of term loan. Whereas now what the project is now is giving the CMA data And because it's now already July 2013, March 13 is already available. Earlier it was estimated, now it's actual. And you can immediately see the turnover is only 12 crores. Okay. If you see the projections given earlier, at the time of sanction of term loan, the turnover was expected around 20 to 22 crores. Okay. Including 2013, including the first year of operation. But whereas now you can see clearly that that was not achieved. For the projections for the next coming years, the company is projecting 26 to 28 crores. Okay. So we'll see all this. And also, you can see the company has incurred loss, whereas in the projection the company has projected a profit. Okay, company thought it will get a profit, whereas when it's come to actual it was a loss. Similarly, this is the CMA data now given for the working capital enhancement. Okay, so this is the actual and these are the estimates, projected balance sheet. Like the it was brought in. We'll see. So we can start the appraisal for this company. Right, the first thing that you have to do I already told you this. Whenever you get a proposal for working capital enhancement, you should always get the last year's file. Okay, don't just start with the set of papers the companies give to the bank. Right, it's always important because every company will be having a running file, because you will be maintaining a running file for every customer. Okay, so please get back that please get that file and go back to the last year's sanction. In that you have to see last year's process note and the sanction letter. The last year's sanction letter will give you the special conditions stipulated for this company. So you have to ensure that those sanctions terms are complied with, and you have to also look at the process note and look at what are the projections the company has given them. What is the turnover that they said they will achieve in 2013? What is the profit they said? What is the capital they said they will bring in? And now you have to compare the actual with the estimate, whether all of that was as promised was done or not. Okay, so it's very important to always get to the last year's file, right, and see where the original process note and the sanction letter, because unless we see the projections, we cannot judge whether the company has complied with the various terms. Because for this example, we have 2013 actuals. Last time when the term loan was sanctioned, we had the projected data for 13. Now we have the actuals, so we can compare the actuals and the last year's projections. Last time projections. Okay. If you go to the process note and sanction letter of the last year, where to start? Okay. The first thing is start with the assumptions, because when the term loan was sanctioned, there is something called assumption sheet. This we discussed in the last chapter, right? When we're discussing about PQR. We had a set of assumptions. Okay, so based on these assumptions the projections were prepared. So go back to the last year's process note and see the assumptions based on which the P&L account and balance sheet were projected, right? And we can see now, because 2013 has already lapsed. Okay, we can see whether there was any change in the actuals versus assumptions, because the assumptions were prepared, say, based on certain selling price, so many rupees per ton. Now let us see whether the actual market is really whether the actual market rate is really supporting this assumed selling price, and various other assumptions. Let us check them. Okay, so that will be a good starting point. See, if the assumptions turned out to be, if the actuals turned out to be as per the assumptions, there would be no problem. Really, if the actuals in each and every parameter turned out to be exactly as per the assumptions made, then definitely there would be no problem, and the projected profit would have been achieved, the projected turnover would have been achieved, the projected profit would have been achieved, and the repayment would have been happened normally. Okay, but did it really happen? Let us see. So at the time of the original sanction, these were the assumptions made, and this is the present actual. So you can see the installed capacity is it's same. Okay, but if you look at the operating capacity, the capacity utilization, the company could not operate at the estimated capacity utilization of 75%. And this is something which we discussed in the last chapter. If you recall, in the case of PQR, when discussing about that, we said that for a new project, it's always important to project the operating capacity in the initial year at least at a conservative level. Don't project when preparing the project report for a new project, don't project the capacity utilization at 80%, 90% in the beginning years, because that would be difficult to achieve, because there will be initial teething problems. The plant has to be stabilized. That will take time. So from the second year and third year onwards, maybe you can increase the capacity utilization to 80% and so. But the beginning years at least have a conservative operating capacity, say around 65 or 70%. So you can see here the projections were prepared based on the company, the project operating at 75%, whereas actually turned out the company could operate only at 45%. Sale price seems to be okay, 60,000 per ton, whereas actually is around the same level. Raw material requirement was same. Cost of basic raw material. So there was a change in here, right? The projections were prepared assuming that the raw material would cost 30,000 per ton, whereas the actual turned out to be 35,000 per ton. This will severely affect the profitability, because sale price has also come down, because sale price, although on the same level, it is not it is 2000 lower, but okay, it's on the same level, but the raw material has increased, and there's a huge difference. I mean, 5000 compared to 30,000, right? It's huge, right? We're speaking of close to 20%. It's not around 17%. Okay, right? So this is a huge change, right? If the raw material price has increased that much, but to the assumptions, obviously the profit will come down. Okay, and that's why if you see the company has incurred loss. The company has incurred loss. That's not raw material price is not the only reason. Maybe there could have been other reasons, but one of the contributing reasons. Okay, then we can see the cost of space was 10%. This is same. Rest of all are same. You can see here power rate was assumed at 4 rupees per unit, whereas the actual was 5 rupees. At that time itself, it should have been 5 or 6, because to industrial consumers you don't have 4. Sometimes what happens is the companies while preparing the project report, they'll be taking very conservative assumptions so as to boost the profit. You know, you should always think from the point of view of the company's auditors. Okay, the way they prepare the projections is always to have a comfortable DSCR, because they don't want to have a scenario where DSCR is less than 1.5 at the bank norm or less than 1. No, because that will be saying that we cannot repay the term loan. So basically they will be trying to project a higher profit somehow, and higher profit comes from higher, say by assuming a higher sale price, or by projecting a lower raw material price, right? All other expenses they'll try to bring it down, say a lower power rate, and everything they'll try to, on the expenses side they will project a lower rate, and the expense and the revenue side they'll assume a higher selling price. So somehow they'll manipulate those variables and try to get a comfortable profit after tax. Now at the time of the sanction of the term loan itself, these are the things you have to catch as a credit officer, because 4 rupees is too low. It is immediately apparent, because no industrial consumer will be getting this sort of rate. Okay, it's around 6 rupees. So these are the things that you need to look at the term loan sanction itself. Okay, so there's a variation on this. So rest of all seems to be okay, right? So the raw material, you can look at the holding levels. Okay, the holding levels seems to be lower. We'll see why it was lower. The holding levels were lower. Holding levels was assumed to be 2 months, whereas it's around 1 month. But we'll see the reason why this is lower. Is it because the company is really managing with this lower inventory, or it is forced to maintain lower inventory? We'll see that shortly. Loan disbursement, there was a delay of 3 months. DCCO, there was a delay of 6 months. And low repayment, anyway, this is going as per the schedule. No reschedulement was requested. So this is the broad overview of the changes in the actual versus assumptions on key parameters. So the major change seem to be on the raw material and power. Okay. Now there are bound to be changes in the assumptions and in the actuals compared to the assumptions, and that is why we have in the project cost something known as the contingencies. If you recall, project cost had land, building, plant and machinery, and one of the items was contingencies. Contingencies is precisely for this purpose. They in projects of large scale, usually there will be cost escalation. These are beyond the control of the management, and that's why there will be a item called contingencies. And usually banks don't finance these contingencies. Usually this 100% margin is stipulated, but sometimes banks do finance partly, say 50%. Again, it depends on the bank policy. So here in this case, the major changes, as we said, this is a production quantity, right? 2250 versus 3750. That is the capacity utilization was lower. Cost of raw material was a major change. Cost of power and the holding levels. Okay, and the delay of 6 months in the DCCO. Okay, so these were the major changes. This also points out a very important reason why when preparing the original projections at the time of sanction of term loan, it's very important to have a conservative assumptions. Don't be very aggressive. Don't think that raw material price will not go up. It will stay at the base level. Don't assume that the project will immediately start. There will be delay. You have to be conservative while doing the assumptions, right? But anyway, this project has already completed, so let us see. Because if there is a vast variation between the actuals and the assumptions, the project viability itself can be affected. Because the project viability, if you recall, the DSCR, the repayment capacity is based entirely on the projected financials. The DSCR, if you recall, it is profit after tax plus interest on term loan plus depreciation by installment plus interest. Okay, the entire the denominator is what the company has to repay to the bank, installment plus interest. This will not change unless there is reschedulement. So this will be fixed. The only thing that can change is profit after tax, right? Everything will remain same. Profit after tax plus depreciation, the cash profit, right? Everything is fixed. The interest is fixed and installment is fixed. The only variability is PAT. If the projected profit was not achieved, if the projected profit is not achieved, obviously your DSCR will come out. That means the ability of the company to repay the debt will be affected, and that's why the projected profit should be very conservative. At the time of a sanction of a new term loan, this is something you have to seriously look into as a banker. Whether the projected profitability is really achievable. The company will project as it likes. It will project a very rosy picture of the profitability, but you as a banker have to question the assumptions on which this project was on which this profit was projected. Okay, because otherwise, if there is wide variation, obviously the DSA will come down and the loan repayment cannot happen. Which in other words, the project viability is affected, right? So let us look into this company XYZ. So the first point, we need to know whether a project is completed or not. Okay. So now we are looking at the case of a company where it has not come for term loan sanction, it has come for enhancement of working capital, but we as a banker are interested to know what happened to the term loan that we sanctioned last time, last year or 2 years back. What happened to that project? Whether it was completed, what happened to the term loan? Was it fully utilized? Was the capital brought in? Was there any cost escalation? There are a lot of questions to consider. So let us focus on the term loan portion. Okay. Then we can go to the present request based on these aspects, whether we can really enhance the limit or renew the limit. Okay, that's a different issue. But first of all, let us focus on what happened to this project. What happened to the 5 crores which we gave as term loan to this project. So first of all, let us see whether this project was completed or not. So we were given that the project was completed and the DCC originally was April 12, but there was a delay and there's a delay of 6 months but the actual DCC was October 2012. Now, how do you believe that the project has completed? Not just because the company has given a letter that it is completed. There should be a physical investigation. Because this company has come for a renewal of working capital, definitely there will be a pre-sanction unit visit. So definitely you must have ascertained by field level inquiries, unit inspection, that project was indeed completed. And also there will be something called a completion certificate issued by an engineer. Okay, by a bank approved engineer, there will be a project completion certificate certifying that the project was completed. We are assuming that was obtained. We are assuming that the project was completed. Okay, so the project was originally thought of to be completed in April 2012, whereas actually the DCCO was October 2012. Normally it is the practice that we do not specify the exact date, we just say the month and year. So let us give the benefit to the borrower and let us say this was April 2012. Actual was October 2012. So even in the worst case, if it is 31/10/2012, you can say it is exactly 6 months. So maybe it's October. They said it was in October, so we don't know if it's 31st or not. Maybe it was 2011. Get the exact date and calculate the difference, right? So it is less than 6 months. So RBI norms on NPA will not attack here. In case the actual DCCO is greater than, the delay is greater than 6 months of the envisaged DCCO, then definitely will be a NPA. By the way, it looks in this case that the DCCO was manipulated. Maybe the actual DCCO somewhere must have happened somewhere in December. We don't know, December 12 or Jan 13. Or maybe the company is aware of this NPA norm, or the bank itself. This happens, right? Maybe the bank manager or the bank itself might have suggested that if there's a delay of more than 6 months, it will be classified as NPA. So get a certificate from the engineer saying that DCCO was achieved on so and so date. So these sort of things do happen. It's a different question whether you can do as a banker or not. Let's not get into that, but these sort of things do happen. So so the point I'm trying to make is, in this case it's exactly 6 months or around 6 months. So maybe it was manipulated. But anyway, let us assume that DCCO happened within 6 months. Okay, so NPA norms will not apply. Next, let us look at the gross block. Okay, originally the gross block was estimated at 790 lakhs. If you go back to this is the balance sheet, projected balance sheet submitted in the project report at the time of sanction. This is not the actual. This 13 is not actual. Okay, this is projected balance sheet at the time of sanction of term loan. Then the working capital, then the fixed asset, the gross block was estimated at 790 lakhs. From where did this 790 come? It has come from here. Okay, except that marginal working capital, the rest of all is the gross block. Right? You might think that gross block is only the tangible part. Okay, only these 4. But what happens is these items also are capitalized. So they will be transferred to the gross block, and along with the rest of the tangible assets, they will be depreciated. That is the practice. Okay. So this 790, the envisaged gross block has come from here. Okay. So the envisaged gross block was 790, but actually it was 940. Now look at the actual 2013 actual. So this is the actual gross block 2013. This is the CMA data now the company has given for enhancement of working capital, where we have the 13 actuals. Look at the gross block. It is 940. So originally it was 790, 940. So what is the difference? That is around 150. Okay. So there is a increase in gross block by 150. Why would gross block increase? Because there is a cost escalation. So some part of the project cost might have increased. right? We don't know what it is at this moment, but either the land cost has increased, or the construction cost has gone up, or the plant and machinery cost has gone up, or the intangible parts like the interest during construction, maybe the interest component has gone up. We don't know, but due to some cost escalation, the gross block has increased 150 lakhs. Okay. Now this 150 is in addition to the contingencies. If you recall, the original project cost also had a item called contingencies to account for the cost escalation. Now this was exceeded, and in spite of that, in addition, there is a 150 increase. Okay, so there is a cost escalation of 150 lakhs. Now the question is, who financed this 150 lakhs of cost escalation? Because originally the plan was bank will sanction 5 crores and promoters will bring 4 crores. So this would have financed the 790 lakhs of a gross block. And the balance 110 is the margin for working capital, that is financed by the borrower entirely. Now this is not 790, this is 940. 150 has increased. So from where does this 150 come? Bank has not sanctioned any additional term loan, that we know as a banker, because we didn't sanction any term loan. So obviously this 150 must have come from the borrower. Did it come? Let us see. So originally let us go back to the original envisaged project report and see what was the cap. So originally this is the capital. That makes sense. Okay. The project cost is 9 crores, 4 crores is equity, 5 crores is term loan. This is the original plan. Okay. So obviously the envisaged equity is 4 lakhs. It was projected accordingly at that time. But now we are saying there is a 150 lakh escalation in the project cost. So bank has not sanctioned the term loan. So obviously this should have come from the promoter. So is the capital 550 lakhs? Let us see the actuals. So this is the actual 2013 550 lakhs. Is the capital 550 lakhs? No, it is still 400. So where is this 150 come from? So if you see, unsecured loans is a new item. This was not part of the original project cost. So okay. So out of the 150 lakhs, so unsecured loans is usually banks do consider it as part of net worth. Sometimes 50% is considered. But basically this means borrowings from close friends and relatives. Sometimes the promoters themselves will bring in the cap, not in the form of capital, but in the form of unsecured loans. Okay. But let us say this is also part of the borrower's capital. So let us give the benefit to the borrower. So that 150 lakhs cost escalation might have been met in part 100 lakhs by unsecured loans. So still there's a gap of 150 lakhs. We'll see what happened to this 50 lakhs. We'll see how this 50 lakhs was met. So the original plan was equity 4 lakhs and term loan of 5 crores. Okay. But whereas now as per the actuals audited financials, we are seeing that the unsecured loans is 100 lakhs, equity was 400 lakhs brought in. So put together they have got 500. Okay. As a banker, do you feel happy about this? So can we say that as promised, as envisaged, the promoter has brought in his entire capital 4 crores, and not only 4 crores, he has actually brought in additional 1 crore. So this is a very positive development. Can we say that? We cannot say that. Let us see why. Okay. If you go back to the actual 2013 balance sheet, if you look at the 2013 actual figures, you can see here reserves and surplus is negative. What is this negative? The company has incurred loss in the first year. Look at the P&L account, 2005. 205.78. This will go to the P&L account. This will go to the balance sheet under either on the asset side it will go into intangible assets as accumulated loss, or on the liability side it will be showing in the negative reserves and surplus. There is a revised schedule 6 to the Companies Act. Earlier the loss was shown as a positive figure under the asset side under intangible assets, but now the revised schedule 6 of the Companies Act stipulates that the negative figure is to be shown on the liability side itself, right? So we have followed that convention, right? And now we're showing it on the liability side. Okay. So this company has got a loss in the first year, right? So please remember, whenever there is a loss, right, deduct the capital and the reserves and surplus. We always look at the total of capital and reserves and surplus. Both these are borrower's funds. Okay. See, the borrower has infused 4 crores, no doubt, but there is a loss of 2 crores. So who has to bear this loss? So in effect, netting, you do the netting, you will find that the promoters have actually infused only 205.400 minus this, whatever it is, it's around 195 crores. Now the promoter might object saying we infused 4 crores. It is true. It is true that they have infused 4 crores, but because of the loss in effect, because the promoters have to bear the loss. When the profit goes to the promoter, obviously the loss also has to be borne by the promoter. That is the basis of business, right? That is the risk they are taking. All profits go to the promoter, and also losses have to be borne by the promoter. The bank is not going to cut down on its on its term loan outstanding, right? still the 5 crores has to be borne. The promoter cannot say, because I have made loss, you cut down on your 5 crores, I'll pay you only 4 crores. That cannot be said. The loss has to be borne by the promoter. So even though he has infused, the promoters have infused 4 crores, because of the loss, in effect, they have infused only 195. So from now on, we are going to say that the promoters have infused only 195 crores, 195 lakhs of capital. It might sound odd when they've actually infused 4 crores, but that doesn't matter, because the loss will erode capital. Okay, loss erodes capital, right? And if there is a loss, you have to reduce the capital accordingly. So now these promoters have brought in only 195 lakhs as capital. The unsecured loans we can take, so they have brought in only 295 lakhs compared to the envisaged of 4 crores, because the project cost of 9 crores was to be financed by 5 crores term loan and 4 crores capital. So against this 4 crores capital, they have brought in only 295. There is a shortage of 105. Right? Please be very clear on this aspect. Don't say that the promoters have brought in 4 crores. They have brought in, but it was eroded. The loss has to be borne by the promoter. So in effect, after doing the netting with the accumulated loss, the loss for the first year, the promoter seems to have brought in only 195 lakhs. Yes, the unsecured loans was 100 lakhs. You can add it. So put together, they have brought in only 295 lakhs. So there's a shortfall of 105 lakhs compared to the envisaged capital of 4 crores. But how did the project get completed? Right? Now you should think about that aspect, right? When the promoters didn't, when there is a shortfall of more than 1 crore, they brought in only 295 crores. So how did the project get completed? Not only the project was completed, remember, there is a cost escalation of 150 lakhs also. Are you getting this point? Not only they didn't bring their shortfall, not only there is a shortfall of 105 lakhs compared to the original 4 crores, but the original project cost is only 9 crores, right? Against that 9 crores itself, there is a shortfall of 105 lakhs. There is a shortfall of 105 lakhs for the original envisaged project cost of 9 crores. Over and above that, there is a cost escalation of 150 lakhs. So there seems to be a huge gap, 255, more than 2.5 crores. So from who financed this? This is the question. Now you have to ask yourself, right? Is this point first of all clear? What we are trying to make here? Originally, the plan was the project cost will be a project cost, term loan and equity. Okay, this is the plan. Okay, so originally it was thought that the project cost will be 9 crores, 900 lakhs, of which the term loan will meet 5 crores and the promoters will bring in 4 crores. This was the original plan. Okay, so what actually happened when it came to actual project cost turned out to be, there was a cost escalation. Okay, there's a cost escalation of 150 lakhs. This is a cost escalation. We've seen that. Okay, compared to 790 of gross block, there was 940, isn't it? So there's a cost escalation. That is one point. Okay, now the term loan was fully dispersed. That's okay. Equity, we have seen that there is a shortfall of 105 lakhs, isn't it? Because originally they had to bring 4 crores, right? But because there is a loss of around 205 crores, 205 lakhs in the first year, in effect they brought only 195 lakhs. 100 lakhs they brought unsecured loans, you can add up, so they brought 295. So there's a shortfall of 105 compared to 400. Now see this, there is an increase in project cost of 150 lakhs. We don't know who brought this, right? We don't know who brought this. We have to account for this 150, who brought this. Moreover, there is a shortfall of 105. That envisaged 4 crores itself was not brought in. There is a shortfall of 105. So someone brought in this 105 also. So there is this shortfall, right? So who financed this shortfall? The bank didn't sanction additional term loan. The promoters themselves, there is a shortfall. So who financed this? Let us see. Okay, but is this point clear? Okay, is this point clear? Or if you are not understood, in very simple terms, what we'll say is, originally the plan was 900 crores will be sanctioned by 500 lakhs by term loan and 400 lakhs capital. Now the situation has changed to 1050 because there is a cost escalation of 150. The project cost has revised to 1050. This is financed by bank, has sanctioned its 5 crores. The promoters have brought in only 295. Have brought in only, not 400. There is a shortfall. 400 minus 105, 295. So someone else brought this balance. So what is the balance? This is 795. So there is a shortfall, 275. So who financed this 275? The bank didn't sanction. Bank sanctioned only 5 crores. The promoters themselves didn't bring in their envisaged capital. There is a shortfall. So who financed this? 275. Okay, we'll see this. Now to know who has financed that shortfall, now you have to look at the funds flow statement. Okay, I have said this many times before. Funds flow statement, NWC, these concepts, diversion of funds, these are advanced topics. This might seem difficult to you at this stage, since I'm assuming that you are a beginner, right? Learning the nuances of create appraisal. So these concepts can be difficult. From now on, the rest of this chapter can be a bit advanced, but even then, please follow along, even if you don't understand it comprehensively. Okay, you can get back to it, you can replay the video, or you can reread it after a couple of weeks. You will get the concept. Basically it's very simple, but it will take time to sink in. Okay, so but the picture is clear to you, right? What actually happened, that should be clear. Okay, the scenario was originally the project cost was thought to be financed by 500 and 400. This is the original plan. The project cost of 9 crores was proposed to be financed by term loan of 5 crores and borrows margin of 4 crores. Whereas now the project cost is increased by 150 lakhs. So this has gone up to 1050. Bank has sanctioned only 500 lakhs. The promoters didn't bring in their 400 lakhs because there is a loss. There is a 105 shortfall. Okay, they brought in 295, and someone else financed it to make up this total of 1050. Let us not focus on the amount, but that is the point. Someone has financed the. So to get a correct picture, what we need to do is we need to draw up a funds flow statement. Okay, so that will give you a very clear idea. So let us draw the funds flow statement as on 31/3/2013. So this is the funds flow statement as on 31/3/2013. Please zoom in if it is not clear to you. So normally funds flow statement, we discussed this earlier. This will be a difference between this year and last year. So every item will do a subtraction. Capital, for example, capital means capital of 2013. Well, this is 100 lakhs. Say this is 125 lakhs. So we'll say 25 lakhs has flown in. This is a funds flow statement. But for this company 2012 there is no figures because it's a new company. So whatever is the 13 figure will be as it is. There's no change. Okay. So let us look at the long-term sources. The promoters have brought in 4 crores that we have already seen. Moreover, there is an unsecured loans of 100 lakhs, so that is also brought in. Bank has sanctioned 5 crores, yes. So the total long-term sources is around 10 crores. 10 crores, okay. Add up all this, you'll get 10 crores. There's an item called overaging term loan that we'll see shortly, but around 10 crores is the total long-term sources brought in. Long-term sources are promoters and term loans, okay. Promoters, unsecured loans, and term loans. So all to put together have brought in 10 crores. So what was this 10 crores meant for? The long-term sources is meant for long-term uses like the project cost, land, building, machinery, plant and machinery, right? Those sort of things. Okay. So this is the long-term uses. Let us see what happened here. 1135 is the long-term uses. So the increase in fixed assets, as we have seen, is 940. Originally it was thought to be 790, but this has gone up by 150. Okay. So this has increased. Okay. This is the repayment of term loan, that is a long-term use. And there's a cash loss that we'll discuss shortly. But basically the long-term uses were more than the long-term sources. Usually you want a situation where the long-term sources are more, so that difference, that long-term surplus will flow into the flow towards increase in NWC. But in this case, what happened was the long-term uses were more. Okay. So while the sources are only 10 crores, the uses was 1135 crores. So there is a long-term deficit. So there is a long-term deficit. How much is the long-term deficit? 108.73. This is the short long-term deficit. So who financed this short long-term deficit? Someone has to finance. Okay. So if you go to the short-term sources, bank has sanctioned CC of 240. Bank has sanctioned only 2 crores, but there seems to be an excess drawal allowed in the account. So that made 240. Creditors 166. Other current liabilities all put together. The short-term sources was close to 5 crores, 493. Right. Whereas the short-term uses, if you see, it's only 384. So there is a short-term surplus of 108. Exactly, it will be same, right? Okay. So while there is a deficit on the long-term front, there is a surplus on short-term front. Why there is a surplus on short-term sources? It means that the bank finance was not entirely used for the short-term uses like inventory and receivables and all. The creditors were not entirely used for short-term uses. The company had this surplus in the short-term sources, and they were diverted to long-term user. That long-term deficit was 108. So this surplus in short-term was diverted to long-term deficit. Okay. So that's how that 108.73 deficit was met. Okay. Again, might be confusing to you, but please follow along. So that 108.73, that deficit. So that long-term uses were more by 108.73 lakhs compared to long-term sources. That was bridged. That was financed from the short-term surplus. Okay. So there are a couple of points that we didn't mention here. That 26.98 that we showed in the long-term sources, it is an overdue. Okay, the calculation I've shown here, why that is the overdue, you can go through this. Why that is a long-term source is actually not long-term source. If you look at the long-term uses, there's a repayment of term loan of 100 crores, 100 lakhs. Okay, there's a repayment of 100 lakhs. Actually, the company did not repay 100 lakhs. If there's an overdue of 27 lakhs, it means that the company has repaid only 73 lakhs. Okay, actually, instead of showing it here, if we had shown this a netting of 73, that would have been more intuitive, you would have understood, but you can show it that way or this way, that doesn't matter. Okay, the end effect will be same, right? So now listen carefully, what has actually happened. Okay, originally the company thought the project cost will be 900 lakhs. They thought that the 9 crores will be financed by term loan of 5 crores and a borrower's margin of 4 crores. That was the original plan. It also thought that the company will be generating profit from the first year itself. Right? They thought that the company will have a cash profit of 109 lakhs, that is profit after tax plus depreciation. That is the cash profit. Okay, they thought they'll have the profit from the first year. So the total long-term funds, originally they thought that the total long-term funds of this plus this 1009, they thought that with this we will purchase some fixed assets 790 lakhs. The repayment have started in the first year itself. Okay, so we'll repay some 100 lakhs. Okay, this is what the plan was originally. So had it gone according to the plan, they would have had a surplus of long-term surplus of 109.29 lakhs. That would have increased the NWC. That is nothing but the projected NWC, right? If you go back to the projections, see what is that 109.28. That is nothing but the projected NWC. This is the project. This is the balance sheet projected given at the time of sanction of term loan. This is not the actual. Okay, this is the projection at the time of sanction of term loan. Try to calculate the NWC here. This current assets minus current liabilities. What is the current assets? Subtract from 1318.33. Subtract the net fixed assets 686.88 and deposits. Subtract this, you'll get the current assets because all other terms are current assets from here. From this, subtract the current liabilities, this portion, and you'll end up with 109.28. Right? Right? That was the plan. The plan was the company will have some long-term funds. The company will have some long-term uses. After meeting these long-term uses, still the company will be left with a surplus of 109.28, which would have been the NWC. That would have gone into financing the current assets. That was the plan. But what happened? But this is what has happened. The plan was originally that the long-term surplus will be 109.29. This is how. There will be long-term sources of 1009. There will be long-term uses of only 900. That surplus of 109 will be meeting the short-term deficit. That was the plan. But actually it turned out to be like this. The long-term sources did not match up. There was a shortfall. Okay, it was not 1009, it was only 914. There was a shortfall of 95. The long-term uses, however, increased by 123 lakhs. Right? Originally they thought it will be 9 crores, but there was a cost escalation here. Okay, on the gross block. So it has increased by 123. So not only there was a shortfall on the long-term sources, there's also a additional cost on the long-term uses. So there's a double blow here. The double blow is to the extent of 123.02 plus 95. So it is 218.02. So that was how the plan. This is the extent to which the plan has gone wrong. Right? One, the long-term sources didn't materialize as it is. There's a shortfall of 95 lakhs. In addition to that, the cost has gone up. The long-term uses has gone up by 120. Put together, compared to the original plan, there was a downfall of 218. Right? This is the 218.02. So how that was met? That was met by the short-term sources. The short-term sources 492, but whereas the short-term uses is only 384. So that difference, if you calculate, is again 218.02. Now, so basically what has happened is this. Okay, if you want to summarize, this is what has happened. Originally, the company has posted a loss against profit. Okay, so this upset the plans by 195 lakhs. Originally, the company thought they'll have a cash profit, whereas it has now got a loss. So the company has taken a blow on that. Then there was a cost escalation of 150 lakhs. Right? To some extent, this was mitigated because there's an overdue of 26.98 lakhs, which means that the term loan was not repaid. So in a way, there is a reprieve. Right? So the long-term uses have come down to that extent, but still, overall, the long-term uses have gone up by 123. So long-term sources were down by 195 lakhs. The long-term uses have gone up by 123. Put together, 318.02 is the negative blow, the total negative blow the company had compared to the original plan. Somehow, the company has to meet this. One way was to apply for the term loan. Maybe we don't know whether the company has applied or not. Maybe it has applied and maybe the bank has rejected it. We don't know. So somehow it has to meet. Term loan was turned down. They raised some unsecured loans. But still there is a shortfall of 218.02. So what they did, they diverted the funds. 218.02, they diverted. This is how the diversion happened. Okay. Also be careful while interpreting the short-term sources. Okay. Originally, you might think that originally the company thought that it will get creditors credit from the raw material supplies. Okay, creditor of only 29 lakhs, whereas it has got 166 lakhs. Okay, so there's a increase in 136.73. You might be tempted to interpret that this is a positive development, because even though there was a cost. So how did the short-term surplus come from? The short-term surplus. How did the short-term surplus come from? There is a long-term deficit. Okay, for this year there is a long-term deficit 108.73. That was bridged by the short-term surplus. So how did the company get the short-term surplus? One of the components was increasing creditors. Originally it thought it was only 29 lakhs, whereas it was 166 lakhs. So don't think that the creditors are finding the company very attractive, very positively, and they are giving more credit. That need not be the case. It might be the case where the company is unable to repay the creditors on time, right? It might be the case because due to the cash crunch, the company is not repaying the creditors in time. That's why the outstanding is increasing, right? We don't know. So that is the more likely scenario in this sort of a situation, right? So don't take this as a positive development. Again, here also, inventory. Inventory. Originally, they thought 325 lakhs they will maintain inventory, but now it's maintained equal to 271. Okay, debtors 271 102. So why these are lower? These are lower because the company is not able to manage the working capital limit. Now they is not having the funds to maintain that sort of a level of inventory, to extend that sort of credit to the customers, right? If it had the funds, it will have extended 45 days or 90 days. It is not having the funds, thereby it's only it's not extending, because if you look at the turnover, it's around 12 crores, right? Even if it is given 1 month, even if it has given say 2 months credit, it have been around 200 lakhs debtors, whereas we are seeing it's only 1 crore. So there are a lot of interpretations going on here. Please be careful. Okay, so now what do? As a banker, you found out that there is a diversion of funds. The company has diverted short-term sources of funds to long-term uses. So what do you do now? Right. The first point is about the CC. Leave the CC. I mean, we're not going to enhance the CC from 2 crores to 3 crores. That is out of the question. With this sort of a financial position, you're not going to do that. But what do you do about this? I mean, there's a shortfall in the promoter's capital. So what do you do? So to answer the question, you need to know what infusion of funds will make the NWC comfortable. That we need to know, right? Before telling the company bring so much funds, we should know what this amount is. We should know the quantum of funds that would make the NWC comfortable. Okay, let us see. We know what is the minimum NWC. We discussed this earlier in a chapter on assessment of working capital. 25% of current assets for large companies. Okay, so minimum NWC. So let us calculate 25% of current assets. We know the NWC. We know the current assets as on 2013 because the actual balance sheet is out. So that is 384. 25% 96. So this is the NWC. But whereas the actual NWC is this. This also we can calculate current assets minus current liabilities based on balance sheet of 2013. So the minimum NWC should be 96 lakhs, whereas the actual NWC is 108. So there is a deficit of around 205 lakhs of shortfall. So if long-term funds of 205 are infused, then there will be minimum required NWC in the system. Obviously, that's what we are saying. Okay, we are saying that the minimum NWC should be this much, whereas the actual NWC is negative this much. So the shortfall is 205. If the company brings in this much amount of funds, there will be a minimum required NWC. So hypothetically, let us assume that if the company had infused 205 lakhs, what would have happened? The current ratio would be exactly 1.33, because the minimum NWC 25% current assets will be exactly there. If you want to calculate, we can do that. So this is the actual 2013. Let us take the same figures and assume that the company has actually brought in that additional capital of 204.79. So in which case the capital will increase by this much amount, 605. And let us assume with that 205 lakhs, what it did was it adjusted 40 lakhs OCC, because 240 it was, right? So it brought down that OCC to 200. Okay. Let us also assume the creditors was brought down from 166 to 56. So 110 was used here. Okay. Let us also assume that other current liabilities was brought down. Okay. So put together the 205, had the company used it in this way, bringing on the current liabilities, bringing on the OCC, bringing on the creditors. Okay, this would haven't happened. Then if you calculate, now if you calculate the current ratio, current assets by current liabilities, now you calculate it. Earlier you calculate current assets by current liabilities, it will be less than 1. But now you calculate, you will get exactly 1.33. You do that, you do the calculation, because this is the current assets. Okay, so this is the current assets earlier, actuals. NWC negative, current ratio 70.78. But now, had this been the case, had the company infused that shortfall, current assets would be this much, current liabilities would have come down. This is the NWC and this is exactly 1.33. So the company should infuse 204 around 205 lakhs of funds to improve the current ratio as per the bank norm. But can we stipulate this sort of condition? Can the company really bring in this sort of funds immediately? It's not possible. Okay, so again here the practical point comes into view. Theoretically you can calculate whatever you want. Okay, but you can stipulate a condition the company should bring in immediately. The company should bring infuse immediately 2 crores within the next 10 days. You don't put those sort of conditions, because company will not do that, and it will end up being in the sanction condition. That's all. You know? So usually what happens is, usually what banks do is, or what banks can do is, in these sort of situations DP will not be there. If you go ahead and calculate the DP for this based on the 2013 balance sheet, you can calculate this, right? You know how to calculate DP. Take inventory less creditors, right? On that you calculate 75%, right? Paid stock 75%, right? And on the debtors you calculate say 50% margin, subject to limited to 50% of CC limit. You do the calculation. We did this all year. You will get that less than 2 crores. You will not get the DP. The CC limit is 2 crores, but the DP will be less than 2 crores. So usually theoretically what you should do is that difference, that irregular portion of OCC is to be converted into WCDA. But rarely banks do this. Even if the financials are not satisfactory, banks do renew the limit. But at least you have to stipulate this condition in the sanction letter, that company should infuse sufficient long-term funds so that minimum NWC should be available in the system by 36/2013. Okay? This can't be 36. So we are saying we are now in July 2013. The proposal has come to us in July 2013. So maybe we can give say another 3 months, right? So we can say around 39 or 31/12, some point of time. Give them a reasonable time and say a company should infuse sufficient funds so that minimum NWC will be available in the system. Okay. Then you can call for the financials after 3 to 6 months, and then recalculate the NWC and see whether the company has really brought in the additional funds and whether NWC has improved and the current ratio is as per 1.33. Now you might get a doubt that why not stipulate in the condition that company should infuse so and so amount. Why are we saying the company should? Why are we being vague? Why are we saying company should infuse sufficient long-term funds? Why are we not specifying this amount? But sometimes banks do quantify it, because it doesn't make sense if you don't quantify. So you can say like that. So company has to bring in 2 crores capital, say 50 lakhs in the next 1 month, say 1 crore in the next 3 months, something. You can do that. Okay, banks do stipulate it. Basically, whatever is the wording, basically the aim is to the company should bring in the additional funds. Otherwise, you are ending up. What is this position of NWC negative? This company is having a negative NWC position. What does it mean? Current assets minus current liabilities is less than 0. It means the current liabilities are more than current assets. It means the outside parties, that the bank borrowers, the CC limit creditors, they are more. That there is surplus of short-term funds, whereas the current assets are less, and that excess of that amount is diverted to long-term uses. You don't want that. So to counter that, you want the borrower to bring in fresh funds. So you have to ensure that how much he brings in, when he brings in, that's a different issue, but that is the basic point you have to ensure. Okay. So we started with the request of the company for CC enhancement from 2 crores to 3 crores. We didn't discuss that. There is no need to discuss that. Right? If this is the position of the company, bank can safely decline the proposal. Right? It's not in the bank's interest to enhance the limit in the present context. Okay. So let the company bring in its additional funds. Let the promoters infuse additional funds. Then we can see whether to enhance the limit or not. For the moment, we can stipulate some pretty strong conditions to ensure that the promoters bring in the additional funds. Okay. Working capital enhancement is out of the question. So with this, we come to the end of this chapter. It has been I know it's been a difficult chapter. I told this even before. Diversion of funds, NWC, these are tricky concepts. but funds flow statement, drawing up the funds flow. But please remember that you will not be drawing manually a funds flow statement. Okay, most banks will be having this Excel templates. So if you fill up the P&L account and balance sheet, automatically the rest gets populated. You know, the ratio analysis, your MPBF, funds flow statement, everything gets automatically populated. Banks will be having this Excel templates. Your bank will also be having this template. So from the funds flow statement, you should be knowing is the interpretation. You need not know how to drop a funds flow statement, at least know the interpretation. And the way to interpret the funds flow statement is look at the long-term sources, look at the long-term uses, find the difference. We want this to be surplus. We want the long-term sources to be more than the long-term uses. Say this is 100 lakhs. So what this 100 lakhs means, say for example, this is 2012, 2013. Okay, say this is 2012, 2013. Okay, let us say the NWC is here 125 lakhs. Here it is something. Okay, so when you drop the funds flow statement, what you want is you want a position of long-term sources being greater than long-term uses. That long-term surplus, say if it is 50 lakhs, that will be nothing but increase in NWC. So if the last year's NWC is 125, this long-term surplus will grow towards improvement of the NWC from 125 to 175. This difference is nothing but this. Right, so you always want this sort of situation. You want the way to interpret funds flow statement. Okay, the way to interpret funds flow statement. Look at the long-term sources. Look at the long-term uses. Find the difference. This should always be positive. Long-term sources should always be more than long-term uses. And if you find that amount will be nothing but the increase in NWC for these 2 years. In the funds flow statement, you will also be having access to short-term sources and short-term uses. You calculate that difference, short-term sources minus short-term uses. The difference will also be this 50, same amount, but negative. That means short-term sources will be less than short-term uses. So that short-term deficit, that 50 will be bridged by long-term surplus. That is basically funds flow statement. Entirely the crux of funds flow statement is basically that. The long-term surplus will be going towards bridging the short-term. Long-term surplus will finance that short-term deficit. So if you have a 50 lakh short-term surplus, that will bridge that 50 lakh shortfall. Alternatively, if you have a long-term deficit, then there will be diversion of funds. The short-term surplus, obviously we'll be having short-term surplus in that case, then the short-term surplus would have financed the long-term deficit. This is how to interpret the funds flow statement. Okay, so even if you don't know how to drop the funds flow statement, from the Excel template provided by your bank, the funds flow statement will be automatically generated. You interpret only these 4 lines. What is the total of long-term sources? What is the total of long-term users? Find the difference. What is the total of short-term sources? What is the total of short-term sources? What is the total of short-term users? What is the difference? Those two differences will be same. Okay, and that difference is nothing but the increase or decrease in NWC. Entire funds flow statement, that is the concept. That is how you interpret the funds flow statement. Again, this will take time to sink in. You will take some time to understand all this. Okay, but that's all right. Okay, as you keep doing proposals, definitely you will understand this concepts much better. Okay. So with this we come to the end of this chapter. In the next chapter we'll be continuing our discussion in the case studies. We'll take up another case study. This time we'll be focusing on the working capital assessment, right? See you then.